So not only are baggy jeans making a comeback, so are cash out refinances. I know, that sounds crazy, right? With rates sky high, why would anybody want to refinance into a higher rate? Well, I'm gonna explain that in this video. Before I do though, do me a huge favor, please hit that like button. Make sure to follow the channel so you get more content like this. So what is going on with consumers? Have they completely lost their mind?
Okie dokie. How's this?
Clark, have you lost your mind? Where did you get that?
I mean, why would somebody that has a 3% interest rate refinance to go have a 6-something% interest rate? You'd have to be Looney Tunes to do that, right? Well, maybe not. When you look at the numbers, it's eye-opening to see that consumer spending habits, both in their savings and in their consumer debt, have completely taken a turn since COVID. Let's check this chart out. And so this chart, I didn't just make this up. This isn't some anecdotal Aaron Klaus thing. This is real data from the Federal Reserve, okay? And what we're looking at is the personal savings rate. And they basically show what percentage of income Americans are saving in their accounts every month. And what you'll see is that basically when COVID hit, that big gray line in the center there, everybody started hunkering down. Remember that period where like there were fist fights out in the parking lot of Costco for people, buying toilet paper and all sorts of crazy stuff. Our habits, basically, we hoarded everything for a short period of time. But then the period of excess came and people started spending money. And you'll actually see those arrows right there, those are stimmy checks. So that's when the government started stimulating the economy and putting money in the pockets of everybody out there. And so what you'll see is that personal savings actually went up. Everybody was kind of sitting on the money, not knowing what they were gonna do with it because they still thought the world was gonna end, basically, right? Well, as you fast forward into time, what happened? People started spending their money. And so you'll see that at the times where consumer savings rates went up, it was during the stimulus. And in fact, as we get closer to today, all the way to January of 2023, you'll see that personal savings is almost at an all-time low. So on the flip side, let's look at consumer credit cards during that same period of time. Credit balances, lines of credit, stuff like that. Not just plastic in your pocket, but consumer credit, okay? Now, when we get to the pandemic and that stimmy money started coming in, because everybody was getting money that they weren't used to having, right? Well, what happened? We saw those balances actually decline. Plus, people didn't spend money for a short period of time. Everybody was freaked out. But that all changed, and people started spending money like MC Hammer. And what we've seen actually is a steady incline in consumer credit balances. And now, if you go back to where that 14% is, that's what the rate on the average, the rate that they were paying for this credit before the Federal Reserve started ratcheting up interest rates. Well, now those people are paying 20% rates on average, and they have more debt than they had when the rates were lower. So people are feeling the pinch in their pocketbooks due to less stimulus money, less savings, less disposable income, yet they're still spending, still buying things, still racking up debt. And so for that reason, we're actually seeing people take advantage of what's called a cash out refinance, where they are refinancing their mortgage. And I get it. It sounds a little crazy because what if they got a 2.75%? Well, that's all good and everything, but if you're paying 20% on a bunch of credit card debt, and you're like most consumers, and you have a car payment of an average of $800 a month, maybe you got 2 car payments, who knows, maybe you're a 2-household house and you got 2 car payments, that's $1,600 on average. You got student loan debt, you got line of credits. There's all sorts of things that consumers have tapped into that are eating into their disposable income that are at a higher rate of interest than what they could get on a 30-year mortgage. And so we're actually seeing people walk away from those really low mortgage rates to take a higher rate so that they could still save hundreds, sometimes even thousands of dollars per month on their monthly cash flow by consolidating their debt into one payment. So what do you think about this? Are people crazy? Put it in the comments below. Maybe I'll make a video about it. See you on the next one.